The stock market has been in a corrective phase. Most people thought that this would be over soon, but here we are months later, still waiting. Some stocks have risen since then, and this has resulted in investors putting their money into further concentrated choices, only exacerbating the issues. But we really don't need to worry because global debt is only $247 trillion. You came here for the truth, so let me unveil that for you today. We are looking at QE4. We are going to talk about oil. We're going to talk about all different markets. Let's begin by taking a look at this report out of Morgan Stanley, who has said the projection for the SOMA portfolio size under our base case scenario is September 2019. That will end their balance sheet normalization. So you will see that right here. And it is an absolute fact that we have seen stock markets rising in direct correlation to assets being purchased by central banks. Their balance sheets, the G3 central bank balance sheet, 4, 5, whatever you want to look at, is in direct correlation with, in particular, the US stock markets. And then we look deeper into what the stock markets have been really doing in recent months, because the Federal Reserve has kept QE3 steady and stagnant. As soon as they started to normalize their balance sheet, we saw the weakness prevail. We saw the market thinking, okay, I think they're really serious now. So it hasn't been able to rise back to where it was before, and I'll cover that more in a moment. So Morgan Stanley is predicting this time frame, September 2019. I'm not saying that myself. I don't know when it's going to happen. I don't know the day, I don't know the month, or even the year. But what I do know is that we're headed for disaster. Without their ability to print money, there's no way stocks can rise. And what they say here is essentially that they will have to end the normalization and increase their balance sheet. And how do they do that? Well, QE4. They're going to have to engage in the next monetary quantitative easing measures. There's just no way around it. So let's take a look further into this, and I want to break it down for you very simply. The S&P 500 is approaching a bearish milestone. The S&P, this is from July 13. The S&P is a day away from its longest stretch in correction territory since 1984. So we've already surpassed that. We've already gone beyond what we saw from 2008, and now we're in this zone from 1984. We're going to surpass it again because it's 122 trading days. This is from July 13th. It's going to take several days, even if the market does well, from here to the, over the next several trading days. We're still not going to get to that point, and it wouldn't surprise me to surpass this level from 1984. So what does this mean exactly? Well, the market, we saw it late January, it starts falling down. It came down, I think it was a maximum of 12%, if I remember correctly. So it came down about 12%. And then it had reversed, but it's really been trading within this range. In the meantime, you've seen certain stocks like the FANG stocks. They have risen beyond their previous highs. They're doing well. Most of the money is now going into those. But the general market hasn't risen past that. And that is really a bearish trend to begin with, because we typically see this at the top of cycles, and that is very worrisome for those who have invested. So this is from an article from May. So they're talking about how we are headed towards that territory of 2008, not being able to pass that. And I just wanted to touch on this point here. The S&P 500 has been in correction territory, which is defined as a decline of at least 10% from a recent peak for 57 trading sessions. All right, so that right there shows me the weakness that has been prevailing. And we've seen this going on now for a little while. It has been since, the beginning of January. We're talking about 6 months here at this point. It's not, just a few days and the market's weak and then it turns around. We're looking at the general market. The reason why people don't feel that it is worrisome, it's those who have FANG stocks. Look at Berkshire Hathaway as an example. It has come down since then. We're talking about supposedly the best investor in the world, legendary investor, and here he is. The stocks that he owns, the companies that he owns here are not doing as well as they were 6 months ago. So what are they doing? What are they planning? Well, the central banks have to, in this case here, they're going to dry up the liquidity, cause a crisis, and then have a reason to implement new bailout measures, new bail-ins. They will be able to do everything that they really, really wanted to do back in 2008, but never had the chance. So all of those lending rules and everything, they've lessened all up on that. The restrictions are all gone. It's a free-for-all again. You're not allowed to talk about it because there's this consistent meme out there of repeated garbage that, you know, they've really fixed all the holes this time around. They've repaired the mess. It will never happen again. But I don't know about you. I'm not a child, and I do not believe in fairy tales. Okay, we have Snow White and the Seven Dwarves. We have, what is it, Sleeping Beauty. We have Cinderella. Great stories, right? Great stories. They've made a lot of money from these stories. They've adapted them onto the big screen. They've had, you know, different plays about these things. But it's not real. It's not real. Okay. Just gotta cool my jets. All right, here we go. So we saw during the financial crisis, by the way, we're looking at the MSCI All Country World Index, not the S&P, not the NASDAQ, not Amazon stock. We're looking at the world indexes, and it dropped during the financial crisis approximately 60%. Then we moved in to the Europe and Japan, had a little bit of a recession going on here, 26% down during this time frame on the world stocks. Specifically, Europe having the whole sovereign debt crisis that was going to cause the next financial crisis. They came in, they printed trillions and trillions and trillions of dollars from the ECB. They bought up all the corporate debt. They bought up all the toxic garbage. They made one country bail out another. Germany is owed $1 trillion. But hey, no trillion euro, I should say. And nothing to worry about there. Everything's just fine. The economy is doing great. Then we had this whole emerging market commodities recession here where things started tumbling down. Oil obviously being a big factor there. And then it is, by the way, and hold on to that thought, and this right here talking about, you know, what's happening, what are the next issues that will be presented. Is it the trade issues? Will we see quantitative easing measures? We don't know. So it's a big question mark right here at this point. And that brings me to this. Now, I always talk about this, but I never seem to have the chart available when I want to mention it. So I purposely put the chart here. Now, what we're looking at is just before the price of oil. This is WTI crude. Just before WTI crude took this big, huge fall, it came to a point where, you know, after the financial crisis, we saw this rising, and it rising to such a level. I mean, it's dramatic. So it was, I think it was something like $35 a barrel, and this was coming after, by the way, you know, $150 a barrel or so. So we had this like $35 a barrel time frame. Within a short period of time, things rose again. The markets apparently were doing fine, and it's so wonderful. And then for several years, we saw the market trading in this range. So it's around $100 a barrel, okay? So we see it around $100 a barrel, and this was going on for a little while, and the market was just dealing with it because they said that, you know, it's going to be okay. The market's doing great now. Economies are booming, so on. But this moment in time right here, it was interesting. Because the reason that they told us, the reason was very, very simple. And it was brought out in the media over and over and over again like a story, like a fairy tale. It was a glut. It was too much oil all of a sudden. And the market came down from $100 a barrel to about $30 a barrel. Now, I could understand how you could tell me, how it can go from $35 a barrel up to $100 a barrel. I can get that. Because they're worried. And when you're worried, everybody just sells and they go into safe haven type assets and they sit and wait and then they're ready to invest again. But to go from $100 a barrel down to $30 a barrel because all of a sudden there's a glut, I don't believe it for a second. This was being used to punish the oil producing countries, some of them in particular. Okay? That's what this is all about. Financial weapons, essentially. That's what these are. They can manipulate prices down as far as they want. As far as they want. There's more pressure when they go too high or too low, but they can do it. It's all up to them. And so we've seen it rise ever since. All right? So these are what we need to be paying attention to. What's going on in all markets, not just a few stocks in the NASDAQ. Don't go anywhere. Make sure you watch part 2 of this video. Lots of information to get into. Click on the link in the description. See you there.